Question 1. A building insured under a standard business owner's policy, BOP, has been vacant for 75 consecutive days. If a loss occurs due to vandalism, what amount will the policy pay? A. The full amount of the loss, less the deductible. B. 85% of the loss, less the deductible. C. 50% of the loss, less the deductible. D. Nothing. Answer: D. Nothing. The policy will pay nothing because coverage for vandalism is suspended if the insured building has been vacant for more than 60 consecutive days before the loss occurs. While some perils like fire would be covered but reduced by 15%, the vacancy condition specifically eliminates coverage for vandalism, sprinkler leakage, building glass breakage, water damage, and theft. The key here is the specific peril of vandalism combined with the duration of the vacancy exceeding the 60-day threshold. Always check the policy's vacancy clause, as certain coverages are suspended entirely, not just reduced. Question 2. An insured's home is covered by a DP3 policy. During a heavy storm, a large tree is blown over by the wind, damaging the roof. The wind itself is A. Proximate cause. B. Hazard. C. Indirect loss. D. Peril. Answer: D. Peril. The wind itself is considered a peril, which is defined as the direct cause of a loss. In property insurance, perils are events like fire, wind, hail, or theft that can cause damage to insured property. A hazard, by contrast, is a condition that increases the likelihood or severity of a loss, such as having a dead tree, a physical hazard, close to the house. The damage to the roof is the direct loss, and any additional living expenses incurred would be an indirect loss. A simple way to remember this is that a peril is what caused the loss, while a hazard is a condition that made the loss more likely to happen. Question 3. Under a commercial general liability, CGL, policy with a general aggregate limit of $2 million and a per occurrence limit of $1 million, the insured has one claim during the policy term. A fire originating from the insured's completed work at a customer's site causes $1,200,000 in damages to the customer's building. How does this claim affect the policy's aggregate limits? A. The general aggregate limit is reduced by $1,200,000. B. The general aggregate limit is reduced by $1 million. C. The product's completed operations aggregate limit is reduced by $1 million. D. The product's completed operations aggregate limit is reduced by $1,200,000. Answer: C. The product's completed operations aggregate limit is reduced by $1 million. The product's completed operations aggregate limit is reduced by $1 million, which is the per occurrence limit paid for this specific claim. CGL policies have a separate aggregate limit for losses arising from products and completed operations, distinct from the general aggregate that applies to premises and operations claims. Since the loss arose from completed work, it is paid up to the per occurrence limit of $1 million and reduces the dedicated product's completed operations aggregate, not the general aggregate. Remember that CGL policies treat products and completed operations claims separately, so they have their own bucket of money to draw from. Question 4. An applicant for an auto policy states that he has had no moving violations in the past 3 years. This statement, which he believes to be true to the best of his knowledge, is known as A. Warranty. B. Representation. C. Concealment. D. Waiver. Answer: B. Representation. This statement is a representation, which is a statement made on an application that the applicant believes to be true to the best of their knowledge. Unlike a warranty, which is a statement guaranteed to be true, a representation only needs to be substantially true. If the applicant had an old ticket they forgot about, it would be an innocent misrepresentation. If they intentionally lied about multiple recent DUIs, it would be a material misrepresentation that could void the policy. Think of a representation as telling your story on the application, while a warranty is like a sworn promise that is part of the contract itself. Question 5. The legal principle that prevents a party from reasserting a right they have previously waived is known as A. Adhesion, B. Subrogation, C. Estoppel, D. Indemnity. Answer: C. Estoppel. The principle described is estoppel, a legal doctrine that prevents a person from asserting something contrary to what is implied by their previous action or statement. If an insurance company consistently accepts late premium payments from a policyholder without issue, an act of waiver, they may be estopped from suddenly denying a claim because the premium was late on that occasion. In essence, the insurer's past actions led the insured to believe that late payments were acceptable, and the insurer cannot go back on that implied promise. A good tip is to remember that waiver is giving up a known right, and estoppel prevents you from taking it back. Question 6. An auto repair shop has a garage keeper's policy written on a legal liability basis. A customer's car is damaged by a tornado while parked overnight at the shop. The shop owner was not negligent. How will the policy respond to the customer's claim for damage? A. The policy will pay the full value of the damage because the car was in the shop's care. B. The policy will pay nothing. C. The policy will pay the claim but will subrogate against the customer's auto insurer. D. The policy will pay the claim after the customer's policy pays its limit. Answer: B. The policy will pay nothing. The policy will pay nothing because coverage is provided on a legal liability basis, which means the insurer only pays if the insured, the repair shop, is legally responsible for the damages. Since the damage was caused by a tornado, which is an act of God, and the shop owner was not negligent, there is no legal liability on the part of the shop. To have coverage for such an event, the shop would have needed to purchase direct primary or direct excess coverage, which pays regardless of fault. Remember, legal liability coverage means you have to prove the insured was at fault for the loss to trigger a payout. Question 7. Which of the following describes the concept of vicarious liability? A. A person is held legally responsible for their own negligent acts. B. A person is held legally responsible for injuries caused by a defective product they manufactured. C. A person is held legally responsible for the negligent acts of another person. D. A person is held legally responsible for damages arising from inherently dangerous activities. Answer: C. A person is held legally responsible for the negligent acts of another person. Vicarious liability, also known as imputed liability, occurs when one party is held legally responsible for the actions of another party. This concept is most commonly seen in employer-employee relationships, where an employer can be held liable for the negligent acts of an employee committed within the scope of their employment. For example, if a delivery driver causes an accident while on a delivery route, the driver's employer can be sued for damages. Think of a vicarious as experiencing something through someone else. In this case, the employer experiences the liability through their employee. Question 8. Under the Fair Credit Reporting Act, FCRA, an insurer who obtains a consumer report on an applicant must do all of the following except: A. Inform the applicant that a consumer report may be requested. B. Provide the name of the credit reporting agency if the applicant requests it. C. Provide the applicant with a copy of their consumer report. D. Advise the applicant of their right to request information about the report. Answer: C. Provide the applicant with a copy of their consumer report. The insurer is not required to provide the applicant with a copy of the report, that is the responsibility of the consumer reporting agency. The FCRA requires that the insurer inform the applicant that a report may be ordered, advise them of their right to get information, and, if adverse action is taken, like denying coverage or charging a higher rate, provide the name and contact information of the agency that supplied the report. The consumer must then contact the reporting agency directly to obtain their copy. Remember, the insurer uses the report, but the reporting agency owns it and is responsible for distributing it to the consumer. Question 9. An insured's vehicle is stolen and stripped of its custom audio equipment, which was permanently installed. Under a standard personal auto policy, PAP, how would this loss be covered? A. It would be fully covered under Part D, coverage for damage to your auto. B. It would be covered under Part B, medical payments coverage. C. It would not be covered unless a specific endorsement is added. D. It would be covered under the insured's homeowners policy. Answer: C. It would not be covered unless a specific endorsement is added. Coverage for custom equipment is typically limited or excluded under a standard personal auto policy. The unendorsed policy generally covers only equipment that is original to the manufacturer, and while it provides a very small sublimit, e.g., $1,000, for some electronic equipment, extensive custom systems require a customized equipment and furnishings endorsement. This endorsement allows the insured to add coverage for the specific value of their aftermarket modifications. Always advise clients with modified vehicles to purchase this endorsement to avoid a significant uncovered loss. Question 10. A liability policy that covers bodily injury or property damage that occurs during the policy period, regardless of when the claim is reported, is known as A.N. A. Claims made policy. B. Occurrence policy. C. Retroactive policy. D. Discovery policy. Answer: B. Occurrence policy. An occurrence policy covers losses that happen during the policy period, even if the claim is filed months or years after the policy has expired. The key trigger for coverage is the date of the incident or occurrence itself. This differs from a claims-made policy, where coverage is triggered when the claim is first made against the insured, and the incident must have occurred on or after a specified retroactive date. Think of an occurrence policy as providing long-tail coverage. As long as the event happened while the policy was active, it will respond. Question 11. All of the following are essential elements of a legally binding contract except A. Consideration. B. Legal purpose. C. Competent parties. D. Notarized signatures. Answer: D. Notarized signatures. Notarized signatures are not a required element for a contract, including an insurance policy, to be legally binding. The four essential elements of a legal contract are agreement, offer and acceptance, consideration, the exchange of value, such as premium for a promise to pay, competent parties, those of legal age and sound mind, and legal purpose. The contract cannot be for an illegal activity. While some specific legal documents may require notarization, it is not a universal requirement for contract validity in the context of insurance. The key takeaway is to know the four core components that make any contract enforceable. Question 12. A fire that starts in an insured's home spreads to a neighbor's house. The damage to the neighbor's house is considered A. A general damage. B. A punitive damage. C. An indirect loss. D. A direct loss. Answer: D. A direct loss. The damage to the neighbor's house is a direct loss, as it is physical damage to tangible property directly caused by a peril, fire. Even though the property belongs to a third party, the nature of the damage itself, the physical destruction of the house, is direct. This would be covered under the liability section of the insured's homeowners policy, but the damage itself is still classified as direct. Indirect losses are consequential financial losses, such as the neighbor having to pay for a hotel while their house is repaired. Question 13. Which of the following best defines the principle of indemnity? A. To place the insured in a better financial position after a loss. B. To punish the party responsible for a loss. C. To restore the insured to their approximate financial position before the loss. D. To transfer the insured's right of recovery to the insurer. Answer: C. To restore the insured to their approximate financial position before the loss. The principle of indemnity holds that the purpose of insurance is to restore an insured to the same financial condition that existed prior to the loss, but not to allow them to profit from it. This is why most property policies pay based on actual cash value, ACV, which accounts for depreciation, rather than the full replacement cost. For example, if a 10-year-old roof is destroyed, indemnity means the policy pays for the value of a 10-year-old roof, not a brand new one, unless replacement cost coverage was specifically purchased. The core idea is to make whole, not to make better. Question 14. An agent assures a client that a certain type of loss is covered under their policy, even though the policy language excludes it. If the insurer is later required by a court to pay this claim, it would be due to the agent's exercise of A. Express authority. B. Implied authority. C. Apparent authority. D. Fiduciary duty. Answer: C. Apparent authority. This situation is an example of apparent authority, which is the authority that a third party, the client, reasonably believes an agent has, based on the actions or representations of the insurer. Even if the agent did not have actual or express authority to bind coverage for that peril, the insurer created the appearance that the agent did, for instance, by providing the agent with logos, applications, and business cards. The insurer is then stopped from denying the claim because the client reasonably relied on the agent's assurances. Think of apparent authority as what the customer perceives the agent can do, based on the insurer's presentation. Question 15. The terrorism coverage provided under the Terrorism Risk Insurance Act, TRIA, is triggered only when the damages from a certified act of terrorism exceed what monetary threshold? A. $5 million. B. $50 million. C. $100 million. D. $200 million. Answer: D. $200 million. For the federal government's backstop to be triggered under the current iteration of TRIA, the total insured losses from a certified act of terrorism must exceed a specific program trigger, which is $200 million. Once an event is certified as an act of terrorism by the Secretary of the Treasury, Secretary of State, and Attorney General, insurers must pay claims. However, the federal government's cost-sharing program does not activate until this aggregate industry loss threshold is met. Remember this high threshold, as it is a key feature distinguishing a TRIA event from a smaller-scale incident. Question 16. In a surety bond, the party who agrees to be responsible for the debt or obligation of another party if that party defaults is the A. Principal. B. Obligee. C. Surety. D. Grantor. Answer: C. Surety. The surety is the party, typically an insurance company, that guarantees the performance of the principal to the obligee. In this three-party contract, the principal is the one who has the primary obligation to perform a task, like a construction contractor, and the obligee is the party to whom the obligation is owed, the project owner. The surety provides a financial guarantee that the principal will fulfill their duties. A good way to remember the roles is: the principal has the principal obligation, the obligee is the recipient of the obligation, and the surety provides the financial security. Question 17. Which homeowners form is specifically designed for tenants or renters living in an apartment? A. HO3. B. HO4. C. HO6. D. HO8. Answer: B. HO4. The HO4 form, often called the contents broad form, is designed for tenants who rent their living space. It provides no coverage for the dwelling or structure itself, as that is the landlord's responsibility, but instead covers the tenant's personal property against broad form named perils. The policy also includes personal liability coverage and additional living expenses if the rental unit becomes uninhabitable due to a covered peril. A helpful mnemonic is, HO4 is for renters. Question 18. Under a personal auto policy, coverage for medical expenses incurred by an insured who is injured as a pedestrian by a hit-and-run driver would be provided by A. Part A, liability coverage. B. Part B, medical payments coverage. C. Part C, uninsured motorists coverage. D. Part D, coverage for damage to your auto. Answer: C. Part C, uninsured motorists coverage. Uninsured motorists, coverage would respond to this claim because a hit-and-run driver is considered an uninsured motorist by definition. While medical payments coverage could also apply, coverage is specifically designed to cover bodily injury, and in some states, property damage, caused by at-fault drivers who are uninsured, underinsured, or cannot be identified, like in a hit-and-run. Coverage steps into the shoes of the at-fault, unknown driver and pays the damages they would have been legally liable for, including medical bills, lost wages, and pain and suffering. Think of as a substitute for the liability insurance the at-fault driver should have had. Question 19. An insured owns a rare, antique grandfather clock. After a fire, the clock is destroyed. A standard HO3 policy would most likely pay for this loss based on A. Replacement cost. B. Stated value. C. Actual cash value. D. Functional replacement cost. Answer: C. Actual cash value. A standard HO3 policy covers personal property on an actual cash value, ACV, basis, which is replacement cost minus depreciation. Because the antique clock has aged, its ACV might be significantly less than its market or appraised value, and finding a direct replacement may be impossible. To properly insure such an item, the insured would need to add a scheduled personal property endorsement, which provides open peril coverage for a specific, agreed-upon value. Without this special scheduling, the unendorsed policy defaults to the less favorable ACV settlement for most personal belongings. Question 20. A business stores customers' property for a fee. The legal responsibility that arises from this arrangement is known as A. A bailment. B. A fiduciary duty. C. An absolute liability. D. A contingent liability. Answer: A. A bailment. This arrangement creates a bailment, which is a legal relationship where physical possession of personal property is transferred from one person, the bailer or customer, to another, the bailee or business, who subsequently has possession of the property for a specific purpose. The bailee has a legal duty to exercise a certain standard of care over the bailed property and can be held liable for its loss or damage. Common examples include dry cleaners, repair shops, and storage facilities. Remember, if you're holding someone else's property for a service, you're a bailee and have a responsibility for it. Question 21. Which part of an insurance policy personalizes the contract by stating who is insured, what property is covered, the policy limits, and the policy period? A. The insuring agreement. B. The conditions. C. The exclusions. D. The declarations. Answer: D. The declarations. The declarations page, often the first page of the policy, contains the specific information that makes the policy unique to that particular insured. It details the who, what, where, when, and how much of the coverage, including the named insured, property address, coverage limits, premium amount, and policy effective dates. The other sections, like the insuring agreement, the insurer's promise to pay, conditions, rules for both parties, and exclusions, what is not covered, are more standardized across all policies of that type. Think of the declarations page as the policy's personalized cover sheet. Question 22. Which of the following is an example of a moral hazard? A. Leaving car keys in the ignition. B. Driving a car with worn-out brakes. C. An individual's indifferent attitude towards preventing loss. D. An individual intentionally burning their own building to collect insurance money. Answer: D. An individual intentionally burning their own building to collect insurance money. A moral hazard arises from a person's character flaws, dishonesty, or propensity to create a loss intentionally to profit from insurance. Arson is the classic example of a moral hazard because it involves a deliberate, fraudulent act motivated by the desire for an insurance payout. This is distinct from a moral hazard, which is an attitude of indifference or carelessness, like leaving keys in the car, and a physical hazard, which is a tangible condition, like faulty brakes. The key distinction for moral hazard is the presence of dishonest intent and character defects. Question 23. A property is damaged by a covered peril. The insured must take reasonable steps to protect the property from further damage. This duty is known as A. The duty to defend. B. The proof of loss requirement. C. The subrogation clause. D. The duty to mitigate damages. Answer: D. The duty to mitigate damages. The duty to mitigate damages requires the insured to take all reasonable steps to protect the covered property from further loss after it has been initially damaged by a covered peril. For instance, if a storm breaks a window, the insured should board up the opening to prevent rain from causing additional interior damage. The costs associated with these protective measures are typically covered by the policy, and failure to mitigate could result in the denial of coverage for any subsequent, preventable damage. This is a fundamental post-loss obligation outlined in the policy's duties after a loss condition. Question 24. A claims adjuster's authority to settle a claim for a specific amount is granted in writing by the insurer. This is an example of A. Implied authority. B. Express authority. C. Apparent authority. D. Ostensible authority. Answer: B. Express authority. Express authority is the authority that is explicitly and formally granted to an agent or adjuster, either orally or in writing, within their agency contract or employment agreement. When an insurer specifies in writing the exact settlement limits within which an adjuster can operate, they are granting express authority. This is different from implied authority, unwritten authority needed to perform express duties, or apparent authority, authority a customer perceives the agent to have. Think of express as explicitly stated in the contract. Question 25. An insured wraps a valuable diamond ring in a tissue for safekeeping and places it on a mantelpiece. A family member, thinking it is trash, throws the tissue into the fireplace where it is destroyed by the fire. How would this loss be covered under a standard HO3 policy? A. The loss would be covered because it was caused by the peril of fire. B. The loss would not be covered because it was caused by a friendly fire. C. The loss would be covered, but subject to the policy's special limit for theft of jewelry. D. The loss would be covered under the mysterious disappearance provision. Answer: B. The loss would not be covered because it was caused by a friendly fire. This loss would not be covered because the damage was caused by a friendly fire, which is a fire that is contained in its intended place, such as a fireplace or furnace. Standard property policies only provide coverage for damage caused by a hostile fire, one that escapes its intended boundaries and becomes uncontrollable. Because the ring was destroyed within a fire that was burning exactly where it was supposed to be, the resulting damage is not considered a covered peril. The key takeaway is to distinguish between a fire in its proper place, friendly, and one that has gotten out of control, hostile.